We're here this afternoon with Andrew Jackson, CIO of Cairn Capital. Thank you for joining us.
Pleasure.
So, do you, Andrew, expect long-term political consolidation in Europe or further fragmentation after Brexit?
One of the things that I said the day before the referendum in the UK is that I thought the market was underestimating the possibility that we might vote to leave. And I think the market is still underestimating the possibility that fragmentation will occur. That said, it's not my base case. I think the base case is still, we carry on with this European construct, and we just had a debate before the cameras were rolling about whether we'll actually see Brexit. I don't know what we'll see, but I think we will see further social unrest. I think we're seeing that across the whole of Europe. It's not just the peripheral states that are experiencing that, but I think the possibility of more fractures is real.
And where do you see the geopolitical fault lines really appearing? Because Italy just came up as something that really is going to be contentious in the next few months, but are there any particular other hotspots that you think are going to flare up?
Well, I think we have elections all around Europe this year and next year. I think Spain has already shown itself to be a little fragmented. I'm surprised there hasn't been more social unrest in Spain given the level of youth unemployment that we see there. I think that France is a hotbed, and it's not just the headline-grabbing terrorism that we're seeing in France. I think that France is not as united as it has been in the past, not as united as those who love France as I do would like it to be. And I think the Front National, they're a very dangerous group, but I think that the number of votes that they will get next time round is meaningful, and we can't dismiss that. I mean, it'd be lovely for centrist people like myself, liberals in the broadest sense of the word, to get rid of people like that. But we have to acknowledge the fact that they are speaking for a large populace in Europe, and that's going to be Italy, Portugal, Spain, Greece. Most likely the countries where they're looking at what's happening in Germany and thinking, why isn't that happening here? Just look at the GDP per capita differential between Italy and Germany over the last 5 years, and that will tell you why there is more social unrest in Italy than there is in Germany. I'm a credit guy, right? So if you ask the equity guy, the sun's always shining, and a credit guy is always about to rain. So I'm bound to be sound bearish, and you ask me questions to make me sound bearish in the classic journalistic way, and I have no problem with that. I'm happy to signal the things that I'm worried about, but I think that it's not just Europe. I think emerging markets and US and Europe all have problems that they're facing. But I do think there are a number of investments that are absolutely rock solid, despite what happens. So the way I think about my investment philosophy is that I look at all the different paths that we may take going forward. I don't dismiss paths, even though they might be relatively low probability events. I'm not designing a base case and saying that is what's going to happen. I'm not naive enough to think that I can predict the future, but I am looking at all the potential outcomes. And I'm saying that in the vast majority of potential outcomes, the kind of things that we're investing in will do fine. And actually, there are a lot of really, really interesting trades. And actually, if we think about it from the ability to find trades in Europe I think it's actually easier than it has been for quite some time, bizarrely, as a result of what the ECB has done. The ECB has driven fixed income markets into negative yield territory. But they've also created this big gap between the liquid and the less liquid, the simple and the complex. And the space that we inhabit tends to be the more complex stuff, the less liquid stuff, the stuff that you have to really do your homework on and be comfortable that you can hold it over a long period of time. And in that space, the opportunities are still there, maybe even more rich than they have been in the past. And the volatility that we've seen over the last year, first as a result of what happened in terms of China and oil in November and December, and then January, February of this year, and then the volatility post-Brexit. They throw up more opportunities, not less. Volatility is good for us in that it does give us opportunities to pick up some of these assets. the best trade that you could have done over the last couple of years is just to be as long as you possibly could with as much leverage as you possibly can on the stuff that's most vanilla and boring. Because the European Central Bank has been buying all that stuff. And they've driven yields into negative territory. The data coming out of corporate bond purchases that they've done suggests that almost a fifth of the bonds that they bought were negative yield, and that's, for me, that's a strange paradigm that actually they're buying negative yielding assets but telling us everything's okay. You don't buy negative yielding assets because everything's okay, in my opinion. But that's been the trade. Buy investment grade corporate bonds, buy the Bund. I don't think that's the trade going forward over the medium to long term. I think the trade is to buy things that are more complex, that have a richer yield. And I think there are plenty of things out there for, you call them savvy investors. That's maybe too strong a word for somebody like me, but for somebody who can tolerate mark to market volatility and looks over a medium to long term.
And to what extent are you kind of taking over territory that's been rescinded by the banks?
Oh, that's a tough question to answer. I think banks have definitely changed what they do and will continue to change what they do as a result of changes to capital ratios and other things. I think there has been some disintermediation of banks post the financial crisis. I think that was something that regulators wanted. How much of what we do is sort of stepping on the territory that they used to do? That's a tough one to call, I think.
And do you think European politics will continue to affect the banking sector and by extension perhaps what you're doing as well?
Yeah, I think it will. We're sitting here the day after Mario Draghi had his press conference, and he didn't want to be asked about Italian banks, but everyone wanted to talk about Italian banks again. I think European politics has a very big effect on banks. I think that we will see European banks continue to go through this period where the longer term trend is improving capital ratios, but the short term trends can be meaningful increases in nervousness around NPLs in particular in Italy, but capital ratios more generally. So I think European politics has a large part to play in how we deal with European economies, and European economies, as Mario Draghi rightly pointed out yesterday, are powered by European banks. That isn't the case all over the world, but the European economy is a banked economy and requires banks. And it's not nice for politicians to have to be nice to bankers. It's really tough. But I think that banks are the method by which liquidity gets out to markets and by which entrepreneurs borrow and create jobs and create wealth. So as much as politicians don't like being nice to bankers, don't like to be tarnished as accommodative to bankers, I think in Europe, as Mario Draghi signalled yesterday, we'll have to do things that keep banks solvent and liquid and able to do what we need them to do, which is to lend to corporates.